Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol Associates Asset Management.
Well, hello everybody. It's Joe Pochodyniak here at McNichol Associates Asset Management, your manager for the Alternative Asset Trust. And joining me today is my colleague Ken Reid, portfolio manager extraordinaire. And today we're going to talk a little bit about alternatives. We've been known in the industry for being alternative investors for many, many years. And we felt it'd be a good time to sort of reach out to you and touch base on the wonderful world of everything that's not stocks. So maybe that's a good starting point. What are alternative assets? The way I sort of think about alternative assets is really the investments that kind of the very, ultra high net worth families make. A lot of big pensions and endowments and those sorts of institutional investors. But really, when you think about it, when you say the word alternative, we're essentially talking about everything that's not the stock market or the bond market. And when you get to the issue of what are the benefits of alternatives, that's the benefit. The benefit is including something in your portfolio that's not dependent on the stock market, that's not dependent to an extent on interest rates as the bond market is. And so it adds better diversification. Now, where there's a yin, there's a yang. What are the drawbacks of alternatives? I would say the number one drawback is that they are not as quick moving as stocks. Stocks can, move on a dime, and they're very exciting to watch when you're winning, and very painful to watch when you're losing. Most alternatives don't do that because they don't mark their value at the end of every trading day at 4 o'clock like stocks do. This is a good thing if you're a long-term investor, and we always encourage that here at McNichol. We always encourage you to take a long-term perspective with your investments, and to a certain extent, actually to a large extent with alternatives, you have to, because when you commit capital to a real estate deal or maybe a private debt deal, maybe an infrastructure deal, you are kind of to a certain extent locked in for the long term. There are periodic windows where you can redeem out of that investment, but there's certainly some more embedded discipline on the alternative side that's not always there with the stock market, which is can be sort of a free for all, and we've heard terms like irrational as it pertains to the stock market. Alternatives tend to be a little bit more rational. The other thing too, I'll just mention about alternatives, and some of you might not know this, is that they tend to report on a quarterly basis, just like public companies do. But we don't always have an idea as to exactly what $100 million building in South Florida might be worth until we actually get financial statements from the sponsors. And they're usually down at the ground level. So those are sort of some of the touch points on alternatives. Our firm's background in this area goes back to October of 2010. So this coming Halloween, the trust will be 15. So it's officially a teenager. And we feel really good about that because the track record that we communicate to our investors, as well as people that would like to become McNichol investors, is very lengthy, and it has been tested through some very challenging periods, such as COVID, as well as 2022, which was the year that, quote, nothing in the markets worked. And that, of course, was a period of higher inflation and higher rates. So that's sort of the elevator speech around alternatives. Our focus area in alternatives is very specialized because we are trying to achieve a very specific objective with the trust. So we invest in private real estate. We invest in private equity, both private companies. We do own private businesses directly, as well as through limited partnerships and equity co-investments. And we also have an award-winning hedge fund too. And in that particular situation, you'll be really pleased to know that I'm not the actual hedge fund manager doing all these exotic and sophisticated investment strategies, but instead I am allocating to the experts. In places like Wall Street, Greenwich, Connecticut, and actually around the world. We have partners all over the place, and we're really proud of the relationships that we have. So Ken, I know you help out a lot on the public market side, but you've been here for a couple of years. In your discussions with our investors, what are some of the questions that you sometimes hear about as it pertains to alternatives?
I guess the number one thing that investors talk about is why can't they access these through their own brokerage accounts? And then the number two question is usually to do with liquidity and the difference in liquidity between a stock, a bond, and then a solution like ourselves. So if you want
That's
to
right.
highlight
Yeah.
those two
Yeah.
questions,
Sure.
great.
Those are good ones. The old I want to be part of this $100 million real estate deal, but if I get cold feet, I want to be able to sell it the very next day. So let's talk about liquidity, because I think that's an issue that if you're brand new to alternatives, you do kind of have that, oh my God, why would anybody invest in this? But as you hear from groups like Preqin, actually thousands of investors are investing hundreds of millions of and billions of dollars in this. So let's talk about liquidity. Number one, is our program liquid? The answer to that is yes. We've got tons of liquidity. We've never had an issue where we've had to tell redeeming investors, no, you can't have your money back. We do have a gating provision, so maybe that's something that if you're new to alternatives, you might not be familiar with. What is gating? Gating essentially is like it sounds. So if I get redemption requests that are kind of on the high side, and we sometimes see this when actually the stock market takes a dip. People kind of see the stock market taking a dip, and maybe I should redeem out of everything, and that's first of all, in my opinion, that's the wrong way to think of it. I think when the stock market dips, that's when you should be buying. But with gating, right, when I get a lineup of redemptions, I can just sort of reduce the pacing of those redemptions to maintain the overall integrity of the program, and to ensure that everybody, gets their cash redeemed out in an orderly procession. And actually, I personally and professionally believe that this is in some cases better than the stock market, because a lot of companies will report after the markets close, and if it's bad news that they have to report, well, you're out of luck, right? If you didn't sell before they reported it, which because it's a public company you would not know, and then some bad news comes out after hours, generally what happens is the next morning when markets open, the stock gets crushed. And so you don't always have that problem with alternatives. The other thing too, and I want all of our viewers to know this, is we spend an awful lot of time not only monitoring our own liquidity in the trust, but attempting to ascertain what our sponsors' liquidity is. And that's very important, because if we find out that a company is being sold, or that a building is being refinanced, let's say we were part of a deal that bought a building that was kind of not that well managed, and so we propped it up and got it stabilized in terms of occupancy. What that does is it allows you to refinance your balance sheet for the building, and that kicks out an equity distribution to investors like ourselves. So we spend a ton of time really communicating and being in close contact with our biggest sponsors, because that's frequently where the cash will be coming to you. Now, the other part of Ken's question, which I forgot, I went on quite a bender there with liquidity. What was the first part of your question, Ken?
The,
I'm
fir-
sorry.
the first part was more to do with access and why investors can't get access
Right.
to alternatives
Okay. Yeah. Yeah.
in their
Yeah.
own personal
That's a
account.
great one. Yeah. So the way I was, it's that's a good question. I was actually with one of our planning partners out in Oakville earlier in the summer. And, I said, if anybody that came to this event drove by the QEW or the 401 and saw these big, distribution warehouses, we own some of them. And the question is, well, if they're such good investments, why can't I get them anywhere? And the answer is you can't. And part of that, we think is the Canadian banks. They don't want you in these investments. They haven't figured out how they can make money on them. And the other side of it is that from a regulatory perspective, there is certainly an element of our industry that considers them to be high risk. And I say that advisedly in quotes, because, I just happen to have a better, seat that I can see that a lot of these investments are in fact not high risk. So the accessibility thing is partially regulatory, it's partially financial. But I think the other thing too is you have to think about it from the sponsor's perspective, right? If the two of us were buying a building, 50, 60, $200 million, and we're looking to improve the performance of that building, that's quite a big undertaking, and it can't be done overnight. So we have to ensure that when we get a group of investors together to do this, they're really dialed in and committed. And so that in some ways, I think, impacts the accessibility as well. Typically with alternatives, it is for more experienced investors. So if you're brand new to investing, we can help educate you on alternatives, but they might not be the right thing for you just yet. So hold tight.
Okay, interesting. And then in terms of the deals that you're doing with the alternative asset trusts, are you one of the biggest LPs in the deals? Are you are you the only investor in
Yeah.
the deal, or what kind of size are you looking at when you're
I'd
investing?
certainly, yeah, I did inherit a couple of LPs where I think, yeah, we were maybe way back in the day one of the only LPs, and I really don't like when that happens. The way I think about it is we kind of try to position ourselves as global mid-market players. What does that even mean if you've never ever read a finance book before? We don't want to be the LP coming into like a $2 billion fund with $500,000 because we barely get noticed. By the same token, we don't want to find out that our investors are literally propping up an entire building or company just by themselves. And so, one of the things that I do in my models is essentially model out things like concentration limits. And so I'm both looking at, are we as investors over concentrated at the sponsor level, and also is it possible that we are perhaps is an existing sponsor maybe getting a little bit too comfortable with our investors and think that they can just access capital anytime. So I think they don't let me touch public stock markets around here for good reason. My timing's terrible. But I think that, on the public market side, there's a lot of that too. So you're monitoring concentration limits and risk. And so, we certainly don't want to be the lone investor in the room, but we want a big enough seat at the table where we can essentially advocate for our investors and, speak our voice and have our voice be heard. And, it is a statement of fact that occasionally, an investment doesn't work out for you. And, sometimes you have to talk tough and straighten people out. And that's our job. We fight tooth and nail to make our investors the returns they need to achieve their financing goals and that sort of thing. So, it's important. I'll give you an example. One of our real estate sponsors, Bridge Investment Group, a very good firm. They actually got acquired by Apollo, which is a large American type of investment firm. And Bridge, maybe a year and a half ago or more, launched the biggest workforce housing fund in the world. And I said that's quite an achievement for sure. But I said, how much money are we talking? And it was somewhere in the order of $2 billion. And I said, wow, that's quite a it'd be fun to play with all that money. But I said, given that we're already in some of the other more focused bridge LPs, we'll take a pass on the workforce fund. I'm sure it's impeccably run. They're a great group, but it was just quite a large pool of capital, and I didn't want our folks to be sloshing around in that, because you sometimes do get lost in the scrum there.
Or then, in terms of the alternative asset trust at this juncture, what are the, I know the buckets, but just for the viewers, what are the three major buckets that you're investing into? And then a second question, do you try to keep those equal at all times, or do you more
Yeah.
allocate on a tactical basis, I'll say?
Yeah, so that's a great question. So the three pillars are going to be private real estate, hedge funds, and private equity. And when we started the program, and by the way, I should say it wasn't me that started the program. The program actually predates me. I sort of took it over, and it was a pleasure to take over something that was so carefully crafted from the beginning. The way it started is each of the three alternative asset classes within our master trust were essentially even, and so they sort of migrated and changed the sizing in the pie chart slices that we put out to unit holders. How did that happen? You used the word tactical. I'm not sure if it was tactical in the context of stocks. I think it was more tactical in the sense that in certain points in the cycle, conditions in private markets became uneven. And so things like geopolitical instability, more recently, the changes in trade policy, those sorts of things, have emerged as extremely important. So that kind of led us to avoid certain things. But also, in the last little while, we've seen huge innovation in technology, most especially the rapid advancement in artificial intelligence, or what's called AI. And so private market leaders in this area, I think, really had to build up their capabilities. And what we saw a lot of was people maybe in the scientific community who understood the science but didn't know how to roll out investment offerings to court investors and institutional investors. But then we also saw the reverse of that, which was finance people that maybe wanted to start up a company that they had no idea about, either in the blockchain or for a while, everybody was talking about cannabis and that sort of thing. And so we've seen the whole spectrum of solutions, and we really it's funny. We'll talk to anybody. We'll consider anything. We do unfortunately have to say no thanks to a lot of deals because they just don't meet our criteria. We're very focused and very disciplined, and I've used that word before. And I find the worst thing we can do as an organization is sort of get off track. Like we have a good thing going. It's worked very well. And anytime we sort of get tempted to, do the whole idea of, well, let's try something new, that's usually when things don't go according to plan. So we tend not to try something new that often. And in fact, with a lot of our current sponsors, we're into their third, fourth, or even fifth fund. And I don't think that's a bad thing. I think you, over the years, develop a trust, a rapport, and an understanding of what your sponsors are doing. And in the case of private companies, we've had entrepreneurs start up companies and then move on to the next thing that they're up to. And so we always keep in touch with those people. I should also say one of the great joys of my role here is certainly talking to our investors here at McNichol, but the other one is just talking to a lot of really smart people in finance, in science, and technology, in all these areas. You get to meet them all, and they are impressive. They really are impressive. It's great that I can bring that to our investors. And I learn something new every time I talk to them, which is great. I've always been the type of guy that I like a job that changes. There's new things going on. I could never just sit and do one thing for the rest of my life. So it's great.
And then in terms of actually sourcing your deals, obviously you can't pull up the NAV of a real estate fund or a private equity company
Yeah.
on Yahoo Finance. How are you going about sourcing the deals? And then how do you obviously continuously monitor them?
So I mentioned, in October, the master trust and the LPs will turn 15, but our experience in private equity actually predates that, where the founding partners would do it on a deal by deal basis, and so we got to know a lot of people. We were in a number of databases for a while, and the deals actually come to us, which is interesting because I want to make a point about this. Um, if I've never met you before and you call me saying you're raising 20 million bucks for a deal, right away that's sort of a red flag. I mean, again, hate to be negative, but again, we're fiduciaries. We have a responsibility to our investors. So, someone brand new that finds, my number or email on a database and contacts me, saying they're raising money, that's great. But what if you're in this role, and I know, Ken, you're very focused on the public market side of it. Um, someone's raising capital somewhere all the time, and so we only have so much capital to deploy. We are, again, trying to achieve very specific things for our clients, and so we can't say yes to everything. So the deals usually find us. The people that I think we've really got a very strong regard for, people that we've done business with for years. We'll actually, in our review meetings with them, ask them, hey, what are you seeing on the horizon? And I think that's an important point, because we get a lot of general publications, good publications, right? Like McKinsey publishes a great global capital market, alternative capital market update. CBRE and CoStar have real estate covered from ceiling to the basement, if you'll pardon that pun. But a lot of our actual data, again, is incoming data at the ground level. So the sponsors will kind of tip us off as to what's going on. And a good example of that is a group down in Boca Raton called IP Capital Partners. Those guys are great. They keep us informed. They keep us alert. We know what they know, and it's frequently a lot fresher. So by the time you get, the encyclopedia of cap rates from CBRE, that's good information for every investor to know. But a lot of that information is already 3 to 6 months old. When a sponsor calls you for an update call, they're usually giving you stuff that's a lot more current. And I'm one of those people as an investor that loves being in the know. So it's really exciting to me.
Beyond that, I don't think there's a lot more questions in regard to general alternatives questions.
Sure.
I guess in terms of ours, what currently is the expected return of our investors?
Yeah,
What is the realized return we've seen over the years? And then
sure.
same thing with volatility.
Yeah, so that's a really good point. And I think we should finish up on that, because that is important. You'll recall from earlier in the conversation, I essentially was saying alternatives are great investments. They just move around more slowly than stocks do, and I'm right about that. But one of the things that can be a little bit frustrating if you're brand new to alternatives is you get into them at a time when stocks are hot, and we have seen the stock market in the last couple of days kind of slow down, but in the previous couple of weeks it's been really doing very, very well. And so it came out of that late March and early April period where the trade war was sort of really ramping up. Stocks were getting really crushed, and if you were in alternatives back then, you were kissing your portfolio manager. But what the problem is, again, because of the way alts report their performance information to investors, they can look a little bit like last week's story when stocks are hot, comparatively speaking. And so we always focus on the long term. So number one, what is our long term number. So we're a little better than 9.2%. Annualized since inception. So our long-term number is extremely good. And that's net of not only fees, but also carry. And so, carried interest is essentially the bonus mechanism that, these hedge funds and private equity managers get comped on. They usually don't take a fee. They really are incentivized to perform. And we actually scrub a lot of that out from the numbers. We don't have to. There's no accounting rule or regulatory rule that's saying we do. We just do it so that we can give our investors as close to the exact lay of the land as we have it. And this year we're positive. So at the midway point of 25, we're up just under 2%. And I think that you're likely to see better returns than that in the back half of the year. Again, for a little while, we were using the trust to finance the costs of portfolio insurance. We don't have to do that anymore. We've got our own dedicated safe harbor fund, which I think is great. And we did have some headwinds as well on the currency side. So that's maybe the final point, is that with alternatives, we do go down into the United States. I know the relationship is a little bit funny, but we're still partners and friends. And from an investment perspective, that market for alternatives is about 20 to 25 times the size of the opportunity set here. So, politics aside, I hope our investors and prospective investors will respect that. This is sort of a business investment type of decision. And so we go to where the capital is treated the best. And I think that's about it, Ken. So, yeah.
Yeah, I think that's it. I think just at the end, just contact us if you're a prospective investor, and make sure, obviously.
Yeah. Nothing we've said here is direct investment advice. Contact us if you want it. We've been doing it for well over 2 decades. Excellent. Thanks so much, Ken. And thank you for watching, everyone. Take care.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks, and visit McNicholasset.com to learn more.